All right, welcome everybody to our webinar on Tax Day, April the 15th, 2025. Appreciative of those of you who are able to tune in live, and for those of you who are watching this as a replay, thanks for taking the time to do so. We did get some helpful questions from some of you, and intend to also make time available at the end for those of you who are tuning in live, who would like to watch or would like to put your questions forward at that point. So in case you are connecting late, uh, recommend that you may want to keep your camera off, and obviously it's helpful if you're muted for the time being until we open it up. And at the end, when we have questions, we'll turn off the recording so you don't have to worry about being captured. All right. So we wanted to do this because we haven't done a webinar in a little while, and also we know that when the market is tumultuous, it can be helpful to be able to ask some questions. The questions you have are probably questions that other people have had as well, and that's certainly the case, I think, from what we've seen. And I thought I would start with one that is a little bit well, maybe we'll start with a softball. We have a number of younger clients, and in their late 20s, early 30s, and they've asked the question about whether, given what's happening in the market, they should make any changes to their portfolios. So, Kale or Senior, what are your thoughts on a younger investor and whether they should make any changes given recent market conditions? You're muted, Senior. I saw you winding up,
There we go.
but your video's off now.
I know.
There we go. All right.
Okay.
We won't make any jokes. So just
Let you joke as much as you want.
right.
The bottom line is, I don't think there's ever a bad time to invest in the market. The question is where you invest in the market, and that's going to be how you go about it, and to what extent is going to be governed by what your goals are. Near term, intermediate term, long term. How you deploy those funds is going to be dictated by where your objectives or your goals lie, and then weighted by your risk tolerance. How much tolerance do you have for fluctuations and volatility? And we have a great tool for helping people determine, what that where those pressure points are. But in terms of waiting to invest, no, I've never endorsed that, and I've never practiced it personally, and so I think there's always a good time to go in.
Kale, what about you? Someone in that situation make any changes?
Make changes? Maybe. Now would be a good time to look, and maybe if you were if you were doing it yourself, and there were some positions that you might have regretted purchasing already, they might be down, and you could sell them for a tax loss. It could be a good time to get out of something that you kind of regretted being in to begin with. But other than that, as long as you had set up a goal, a portfolio with a long-term goal in mind, I don't think now would be a time to change that.
Yeah. Yeah, I definitely agree. I think it's like I said, this is kind of the softball question. If you're investing for the long term, and even somebody closer to retirement often has a long-term time horizon on their money and how long it needs to be working. So for younger investors, volatility is a great opportunity. But even for investors closer to or in retirement, there are some benefits that come from movements in the market, like you said, Kale, some tax selling. Uh, Although, of course, with markets having done pretty good over the last few years, there were fewer opportunities for that in many cases. Great, thank you. How about this question? In light of recent market declines, is now a good time to take required distributions if you don't need the money for living expenses? In other words, what if you're required to take an RMD and you don't need it? Is this a good time to take that out? Kale, what do you think?
Maybe. I
Yeah.
guess the market went down a lot more. It could be a better time now to take it out. The problem is your RMD is calculated off of your December 31st balance of the prior year. So for the sake of argument, let's say that the market was down a ton. and you took the money out at the bottom of the market before it recovered, you're actually taking a higher percentage of your assets out than you otherwise would if the market was higher. So typically I would not try to time an RMD to take it out at the lowest point of the market during the year.
Yeah, usually we'll encourage people to, if they don't need the money for living expenses, to wait until later in the year, because hopefully the market will be higher than it was at the beginning of the year.
And
Now
statistically, that would be
yeah,
the case.
it can be a good time though for Roth conversions, because you can, if you have an IRA that has declined in value and you intended to convert some part of that to Roth, then it's could be a chance to convert a larger percentage of that account than you would otherwise be able to. So I'd say it's probably a plus for conversions, maybe not for RMDs. What do you think, Senior?
Well, the other option is to average out. So just average your withdrawal out over a period of months. Just it might be a way to spread the risk as well.
Yeah.
So that way you're not, betting on where the market's going to be at the beginning of the year versus the end of the year. Just average out your distribution over 6 months or the 12 months, whatever. So
Yeah. Thank you. All right, so we had a couple of questions about bonds and the performance of bonds, or whether bonds are kind of what the outlook is for the bond market. Is it a good time to increase exposure there, decrease? What are you seeing? And do you have any thoughts on the current situation with bonds?
I have to interject a quotation here that's
Sure.
always amused me. Roger Ingman, who was a portfolio manager many years ago, when I first came into business, he ran a fund called the Nifty 50, which were essentially the top blue chip funds. And his adage was, the only thing bonds are good for is getting out of jail. Um, so that said, obviously for anyone looking to mitigate risk, bonds are an excellent way to do that. And so again, the issue of quality, duration, and yield come into play. And I've always been a proponent of using bonds to whatever degree is appropriate to hedge risk on the equity side. So
Great. Kia, what do you think about the current state of bonds?
I mean, it's hard to figure it out, right? I mean, if rates are cut a bunch, then now would be a good time to buy bonds, I suppose. But there's no guarantee that the Federal Reserve will follow the assumed rate cut schedule.
Right.
I mean, I think bonds are actually up. If you go by the Barclays aggregate, they're up 2% this year already. Again, there are some attractive yields out there. I was actually looking at a bunch of individual bonds today, going out 15 years. There's some attractive stuff that's yielding 6% or more that's credit rated. But again, it depends on what your reason is for, buying the bond to begin with. Long term, equities still provide better inflation protection, but bonds do have, use in a portfolio for sure.
Great. And yeah, certainly there's always been a rivalry between equity managers and bond managers. I think the bonds had held up a bit better in the earlier part of this recent decline, and now part of the challenge we have is the on again, off again situation with the government's policy on things like tariffs. So it's definitely more challenging for businesses to decide the choices they want to make. So bonds have seen a little bit more weakness. We had a very encouraging or I guess positive inflation number for March. There is concern that that won't be the case in April, but there was concern that March would be worse than it was. So the Federal Reserve has indicated that it would likely lower rates this year. Some people think as early as May. We're hearing a little bit more probably likely to do that in June. So that would be supportive of bond holders, of bond prices. It would be a positive for that. And like Kale said, the yields are good. You're getting paid more for bonds as a bond holder than we were, a little while ago. And they're definitely looking more attractive relative to cash, which wasn't the case when the yields on those two assets were pretty similar. So um, the outlook for the bond market, it definitely looks like a good opportunity to be a bond investor, although the volatility we've seen could continue for a little while, and that will have an impact on prices, with the treasury part of the bond market being the most sensitive. So, um, great, thanks for your answers to that. Let's talk a little bit about uh, 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 foreign stocks. What's the outlook on foreign stocks relative to the U.S.? Foreign stocks have looked a little bit better for the first time in a while. What do you all think? Is this a good time to increase your exposure to foreign stocks? Maintain if you're already an owner there, or kind of what's the interplay? Any thoughts on that question?
Well, we've always maintained a position in foreign stocks in our managed
In
portfolio.
general, yeah.
In general, it's always been obviously a minority position. I think you correct me if I'm wrong, Joe, but I think we've probably averaged between I don't know, 14 to maybe as high as 20% over time in foreign stocks, because it made sense. The numbers
Mm,
made sense, the performance made sense, and in fact, if you're invested in most multinational companies, let's say they're U.S. based, you're indirectly investing in foreign economies anyway, because of their broad reach across the world.
right.
So you take a company like Coca-Cola, who's does more business ex-US. Last time I checked, than they do in the United States. So
Hmm.
essentially, you could say it's an international, company. But again, I think maintaining some percentage as a weighting in portfolios of having foreign stocks, I think has always made sense. But whether you go totally in the other direction, generally that hasn't been our practice or our perspective. But again, it's we want to be sensitive to what our clients are desirous in doing. So
Yeah, it's been a hard area because U.S. stocks have outperformed foreign stocks for a long time, and so the appetite for foreign stocks among U.S. investors has been lower, and the dollar has been relatively stronger. So that makes it a little less advantageous for us. Now, given everything that's happening, it's likely that, well, we've seen more weakness in the dollar losing some value relative to other currencies. This is not a danger signal necessarily, because the value of the dollar against other currencies is always fluctuating. I remember taking a political economy class in college 25 years ago when the concerns were that the dollar was too strong. And then, of course, we went through a period of dollar weakness, and now the dollar is strong again. So the ebbs and flows in the value of the dollar have always been something we've dealt with, and that has an impact on the value of, or on the attractiveness or performance of foreign stocks for U.S. owners. Um, on a relative basis, they have done better than U.S. stocks, or at least had. I'm not sure how last week affected things, because last week we had the best week for the S&P since 2023. So uh, we've had an interesting couple of months where we've had some of the worst periods, some of the worst days, some of the best days in the last couple of years. And we'll come back to that question, I think, because that's one of the questions a little bit later, just about stocks in general. But I'd say because we don't know where the advantages in the market are going to come from, it is beneficial to have exposure to foreign stocks and generally maintain that. Um, Increasing or decreasing that is a hard thing to figure out, especially given a short-term movement like we've had recently. Kale, do you have anything to add to that question?
I mean, I keep seeing all these scary headlines about how the dollar is, weakening, but yeah, I went to Europe in 2007 as a college student, and the dollar was a lot weaker then than it is today. So I mean, I think maybe it's weaker compared to a year ago, but not really weak in a, 20 to 30 year
Historical. Yeah.
historical run. And also, as far as your allocation to European equities, I mean, at one point this year, Europe was up 16% when, the S&P 500 was down about 4%. Today, European equities are up 10% year to date versus the S&P 500, which is down 8%. So my concern with adding more European equities at this point would be maybe you're just kind of chasing returns. Maybe you've already missed the best part of the run potentially.
Hmm.
In if you already have European equities and you are, rebalancing your portfolio once a year, twice a year, or whatever your schedule is, you would actually be selling a little bit of the European equities right now and rebalancing back into US equities. So I would be hesitant to make any big moves right now other than some rebalancing. Or if you did have like a really strong opinion on a international outperformance, maybe only increasing a small portion. And remember when we say international, that kind of includes everything. Emerging markets have not done particularly well. Europe has kind of been the bright spot, and a little bit of Japan, I believe, as well. So
Yeah. Thank you. This is an interesting question. It relates to, well, maybe we talk a little bit about tariffs. As you can imagine, our clients run the whole gamut politically, and so there are strong feelings uh, which are affected by how you feel about who happens to be in office. We definitely see that happen if there's a Democrat in office. Our more left-leaning clients are a little more optimistic. Our right-leaning clients are more pessimistic. Likewise, there's a reverse. We can't help but look at the world through a lens that aligns with who we like and who we think is going to do a better job. Those biases are real. Just the same, I don't think anyone can argue that the current situation with tariffs has been, to be kind, a bit sloppy, right? The administration has an objective. Senior and I were talking about this today. Maybe you share a little bit about what you were thinking relative to tariffs, I think, and where this is coming from, I guess.
Yeah, I mentioned to Joe Jr. that our current economic relationships, for a large part, especially with Western Europe and Japan and so forth, were born out of post-World War II, the need for the U.S. to bolster the rest of the world emerging out of World War II and the Korean War and into the 50s, 60s, and beyond. And so the United States has been holding up or held up these economies so that they could come in to their own. And over time, and over that time, as things have evolved, there's been no system of checks and balances on where we are, relative to this country, or that country, and so forth. And so, from a review point of view, we're probably overdue for reviewing where we are relative to the countries we interact with, financially and commercially, in terms of where those tariffs should be, or if there should be any tariffs at all. And I might add too that Europe has had a problem instituting the euro into lesser advantaged countries who've come into the European Union, and so there are ways of overcoming these imbalances, and they're not easy, and they're always going to be painful on the lower income end of the spectrum. But for my part, I don't think it's bad to go in and look and see where we are. But I'd have to concur with Joe Jr. that the methodology has been a little on the rough side, for lack of a better term. There's, and if I can interject here, Joe, there's an excellent book that actually was given to me by my son. It was called "The End of the World is Just the Beginning." The End of the World is Just the Beginning by Peter Zehan. And I would highly recommend it to our clients as an excellent read as kind of some insights into where the world is evolving economically and geopolitically. You might be surprised that what you see happening today is to an extent foretold, by Mr. Zehan in his book. But that's kind of my take. That I think, a review and analysis of where we are relative to others, especially after so many years of nobody, checking the oil, is probably not a bad thing. So.
Yeah, the by any measurement, the U.S. A U.S. citizen is better off economically than they were 20 years ago, 30 years ago, 40 years ago. But there certainly is a feeling among many Americans that they have not participated, and I think the data probably bears out, have not participated equally in that growth when we look at regions of the country that have been affected. And so that's where a lot of this is coming from. And I grew up in an era of really pro free trade, initiatives, policies, and so very much feel like in the long run that tends to be more beneficial. So I that colors my thinking on this issue. We have to be open-minded that some of this may lead to a good outcome. By themselves, the initial proposed tariffs are not enough to cause, we think, a recession in the United States. But what does happen, especially as it seems likely or possible to escalate further, that could change the way businesses and individuals view their spending, view the choices they make moving into this year, and that could have an impact of causing some economic slowdown and maybe even a recession, although that is far from a certain thing at this point. Cale, anything to add on the tariff question broadly?
No.
Yeah. We really would like to see a more cohesive and consistent message from the government. But that's not what we got. So we'll work within it. And I guess what's interesting, and so we had a question about our outlook. Well, let me back up because there was another question, kind of a technical question, which I had to research because I really didn't know the answer to this. I didn't know if either of you had a chance to look at it, but is there, I guess, what's the mechanism for collecting tariffs? Do we have the infrastructure in place to collect tariffs that have been levied? But yeah, the answer is yes. Do you guys know who collects tariffs? Who's in charge of collecting tariffs? A little pop quiz for my friends here.
The tariff collector.
Okay, good. Yeah. So that's Customs and Border Patrol,
Yes.
Customs and Border Enforcement. It's their job to collect tariffs. And so that mechanism does exist. There are definitely more things that tariffs are likely to apply to. And so we'll see how well that goes in terms of the mechanics. But yeah, the mechanism.
I think there was like a
there.
10-hour period where there was some sort of glitch where either nobody knew what rate to collect or they were unable to collect, and there was like a 10-hour window where there's a problem. So I think that could be where that question's coming from. If I had to guess, there's a lot of headlines about that.
Yeah, and we should expect as this uncertainty continues. I have a good friend in Toronto, and his business ships back and forth primarily to the U.S. and most of the products he ships are below the dollar amount that would be subject to the Canada-U.S. tariff. He thinks, it's one of those things where it's a little bit challenging for them to know exactly what to do, and as a result, it's hard for them to know if they need to increase or decrease pricing. So that's part of what's affecting companies right now as they try to make decisions moving forward. So what is your outlook for the rest of the year? What do you think? And this is the most dangerous question I'll ask today, right? Because we don't know. We're going to give you. This always comes up when we do Q&A. Senior, why don't you go first? What do you think we're looking at for the rest of the year?
I would say moderate growth would be my assessment.
So your perspective, you're expecting improvement from the current situation, potentially the market being positive to end the year. Is that what you would see? Or
that's my expectation. Yes.
So with that, I think you're probably imagining that there's some clarity on the tariff question. It gets resolved in a way that's favorable. All right, that's my
Yes.
if I'm
Yes,
putting words in your mouth. All right.
you're free. Feel free to do so.
Kale, what about you? What are your thoughts?
I have no idea. I mean, nothing would really surprise me at this point. I mean, the market was down like what was it, 10% in one day at some point last week,
Yeah, I think
and
on Wednesday, or oh, no, it was up 10% on Wednesday briefly,
and
but yeah.
then the world was ending, and it was going to be this big terrible thing, and then with one reversal on policy that was said in a tweet, the market was up 10% the following day, I believe. I mean, it's really hard to guess what's going to happen when things can change on a whim like that. Um,
So,
I would think it would be difficult for somebody for the market to be intentionally driven down over a long period of time. But I guess there could be some sort of scenario where some economic factor just kind of got out of control and just started spiraling. That'd be like the worst case scenario. But as of now, I don't really see anything that's particularly concerning like that.
mhm.
I mean, so I would say, kind of trading sideways all year, maybe even up from this point a little bit.
Yeah. Yeah.
So,
Go ahead,
so
Senior. Yeah.
if I can inject. I think our philosophy has always been to put the focus on quality in our portfolios and to encourage our clients to keep the focus on quality. The next thing is to resist the temptation to make long-term decisions based on short-term events,
Hmm.
which is a temptation. I remember once, golly, 20 years ago or so, the receptionist said, Mr. So-and-so is waiting for you out front in the reception area. As I'm walking down the hall, this was in our old office, I look at this guy. I could see him from a distance. He looked like death warmed over. And I said, we'll say his name is Ralph. And immediately I said, Ralph, have you been watching CNBC? And
And
he
just so you
said,
know, his name was not Ralph, in case
I
anyone's
know.
wondering.
So
Yeah.
so he goes, how did you know? I said, because you look like you're half dead. I said, you got to stay away from this stuff. Don't let short-term events or the way in which things are reported influence your long-term decisions in terms of your investing, and just keep the focus on quality. So that's
Thanks
that's
for
what I
sharing that,
want.
both of you. And I think what we would hope you would remember is in a setting like this, when we're giving broad general answers to these questions, your specific needs and situation will is its own determinant of what you should do. But in general, these are principles that we think are almost eternal in an investment sense. And what Senior's alluding to, that noise that was experienced, I was not yet working with you at that point, but you told me that story shortly after I joined you, because I think that was 2001. So we're about
Correct.
a year into the market decline of the tech bust, and it was very difficult for investors to stick with it after more than a year of a declining market. And if anything, that's been amplified today because we have now social media. The news cycle is much more rapid than it was at that point. You can not only see everything happening in real time, but have people talking about it and those voices amplifying. And the other thing that's the trend that has also intensified over recent years is rapid trading. We in the 2010s, a lot was made of the Fed and when the Fed would adjust interest rates. And you could see a lot of investors timing their movements in the market based on what the Fed was doing. Now, for longer term investors, so we put ourselves in that category versus short term traders. Short term traders are trying to take advantage from those small day to day, week to week movements in the market. The experience for long term investors has not really changed because we're measuring our experience in the market not over days or weeks, but over years. And so those long-term trends have not really changed, even though there's more noise and there's more movement and sometimes volatility in the meantime. And we're seeing the same thing played out over the last few weeks. Uh, People trying to time movements in and out of the market to eke out those incremental advantages. And so if the tariff policy is released and it looks very punitive and we're worried about retaliation against the US, You'll have a lot of people piling on that sell and more people selling, and it sort of becomes a herd. And then, like Kale said, you get a positive potential tweet, and then everything moves back the other way because nobody wants to be left out on the buy side either. And if you were a longer term investor, you've really benefited for the most part from not engaging because it's very likely at some point you'll be on the wrong side of that trade. You'll have sold too late or bought in too late or done both and been doubly wounded by your efforts to miss out on that pain. So all this is to say we don't know what holds for the rest of the year. I agree with Kale and Senior. There was nothing obvious in the market or the economy indicating a recession or a prolonged downturn. The economy is likely to continue growing. We do expect a continuation of the current tax policy or something very close to it. That is generally positive for the economy and for the markets. Fiscal issues are a whole other question, be dealt with on another day. But anyway, so I'd say if we're just looking at the potential performance for the economy, we expect the economy to expand modestly. And with that, we would hope to see some improvement in the market, certainly from where it is today. Anything else to add to that, either of you?
No, I'm good.
Great. Let me see if we had any other questions. I think that's it. So what I'm going to do is we'll pause the recording and see if any of you have questions you want to ask. So this question relates to, is there any realistic chance for the administration to restructure to a flat tax? There's been talk of flat tax for now decades, I think going back to probably the mid 90s, maybe before, but I think it was Steve Forbes, right, back in the mid 90s who really, was it mid 90s? Anyway, who really was promoting the idea of a flat tax. So no, I'd say there's no realistic chance under the current administration. It would require a really significant congressional support, and the president has not shown a lot of interest in marshaling Congress to make a lot of changes, preferring to act more unilaterally. So yeah, probably not. It is something that's commonly used. Well, actually, no. A lot of countries use a value-added tax, a VAT tax, which is really a sales tax, as their primary funding mechanism.
Consumption.
Yeah, consumption tax. So yeah, it is something that would be interesting. Obviously, we could talk a lot about that, but yeah, unfortunately, no, there's not a big chance of that. Great. Any other questions? Anybody else have anything they are burning to ask or know about or get semi-qualified opinions on? I'll pause the recording again. We appreciate your support. We appreciate your trust. We know there are a lot of things, a lot of questions in any market environment. We have a strong and abiding belief in our economic system. There is always going to be risk. The key is making sure that the potential reward is commensurate with the risk that we're taking, and also remembering the importance of time frames. Somebody close to or near retirement, that money needs to work for them for hopefully decades longer. And so having an appropriate amount of risk to make sure that your money keeps pace with inflation is going to be really critically important. And so what's appropriate for you specifically, that'll depend on your needs and situation. But we are hopeful for a good finish to the year. Senior Kale, do you have anything to add?
Just to express our thanks for your confidence in us and your trust. And as Joe mentioned, we're here for you, and we appreciate the opportunity to work with you. So,
all right. Thank you very much. Let us know if you'd like to talk further. Hope this was helpful.
Thank you.
have a great evening.
Happy Easter to you as well.